Hello and welcome to AFM 451. In the last video, we established why fraud risk is fundamentally different from error risk. Fraud is intentional. It adapts, it bypasses controls. That means auditors cannot solely rely on routine procedures. This is where the fraud triangle comes in handy. When auditors use the fraud triangle, we're not accusing anyone, we are simply assessing the relevant fraud risk factors. Canadian Auditing Standard 240 requires us to determine the risk of material misstatement due to fraud and to evaluate management's controls designed to prevent and detect it. The fraud triangle is not a checklist, it's a structuring lens. It helps us organize our thinking during the fraud brainstorming and risk assessment exercises. It basically asks three questions. What pressures exist? What are the opportunities? And how might someone justify their fraud while perpetrating fraud? Let's start with pressure. Pressure refers to incentives or forces that motivate someone to commit fraud. These pressures can be financial, performance-driven, or personal. When results must be achieved at all cost, risk increases. Examples include executives under market pressure to meet earnings targets. A sales manager is facing bonus thresholds tied to revenue growth. An employee is dealing with significant personal financial distress. In each of these cases, pressure does not cause fraud, but it creates motivation. Next, let's move on to opportunity. Opportunity exists when internal controls are weak, oversight is ineffective, or authority is concentrated. Even strong controls can be overridden when power is centralized. Examples include management overrides of year-end journal entries, segregation of duties breakdown in a small finance team, complex revenue targets where only a few individuals understand the accounting treatment. Opportunities make fraud feasible. And lastly, we have rationalization. Rationalization or justification is how individuals convince themselves of unethical conduct. Most fraudsters do not see themselves as criminal. They frame their actions as temporary, deserved, or necessary. Examples could include, I'll reverse it in the next quarter, or everyone inflates estimates slightly, or the company owes me for underpaying me. Rationalization lowers the psychological barrier to misconduct. As you would have guessed by now, actively identifying fraud risk factors include adopting a professional skeptical attitude as well as performing specific procedures. We should ask management whether they are aware of known or suspected fraud. We attend team planning meetings that explicitly review significant fraud risk factors and financial statement areas susceptible to manipulation. We perform preliminary analytics to identify unusual trends, unexpected relationships, or inconsistencies. We may want to explicitly consider the risk of management overrides of controls because overrides can exist even in well-designed systems. The fraud triangle sharpens audit thinking. It forces structured brainstorming. It connects behavioral drivers with control weaknesses and financial statement impact. Used properly, it elevates fraud assessment from reactive detection to disciplined anticipation. That is how auditors approach fraud risk in a systematic, skeptical, and strategic manner. Thanks for following along. Take care, stay safe, and bye for now.